Bad news for Continental. Does that mean that we should expect similar growth warnings in the sector?
Well, 2019's already been a bumpy road for the automotive sector. So you wouldn't bet on this being the last of the bad news. We've seen sweeping job cuts at Jaguar Land Rover, problems at robotics firm KUKA, and the news today at Continental. And analysts are disappointed, but their chief financial officer was very quick to point to external conditions, explaining that less cars, very simply, means less demand for tyres and brakes. And it does highlight the obvious impact of slowing demand in huge markets like China. Car sales in China dropped almost 3% last year. That's the first time that's happened since the 90s. It is really, really tough out there in automotive. It's increasingly hard for firms like Continental to really get traction.
Turning now to China, there's been some concern for a while now about a possible economic slowdown. The latest export figures are down more than 4% last month. Imports are more than 7%. More cause for concern.
Yeah, well, last week we spoke about China having had the world's worst performing stock market last year, and more bad news today. This trade data shows the biggest decline for 2 years, and it comes at a time when many are really worried about growth in the world's second biggest economy. All eyes are also on the US trade war, and other data released today shows China's trade surplus with the US reached a record high in 2018. That was partly due to businesses rushing to do deals to beat these trade tariffs. So what we're seeing is China's relationship with the world changing. It's enjoyed 20 years of incredible growth, which is now slowing, but it's still well over 6%. So the tough job really now is for firms that have relied on this epic growth to find a new strategy for China.
And turning now to Britain, it's been a year since the collapse of the construction giant Carillion, but it has cast a long shadow. Are there lingering effects on the construction industry?
I think that's inevitable. Carillion managed such huge projects that when it eventually collapsed under the weight of over €1 billion worth of debt, it created real concerns about how giant construction projects are managed and who carries all the risk. Now, a new report by the law firm CMS shows that while most of the leading contractors are confident about the sector, many are really concerned about how risk is apportioned, and also this culture of suicide bidding. This is where companies argue that they're forced to compete for projects with tiny profit margins simply to stay afloat. Now this tends to hurt smaller companies that don't have such great capital strength, but nevertheless it's prompting calls from all across the industry for governments to come together with contractors and find new ways of ensuring the sector gets fit for the future.